Hi everybody, welcome to our Inner Circle webinar for Tuesday the 3rd of September. So today we're focusing all around financial health, which I believe is so important for us mamas to really take ownership of that and not put it in the too hard basket. So today we've got Heather and Adam from Mondy Financial Services on the call. So they're going to give us an overview of some different options, which I'm really excited to hear about. So they run Mondy Financial Services, which is a boutique financial advisory business, and they're in the stunning Blue Mountains, so they've got a nice outlook for work every day. So Adam is the owner of the business, and he's been in the financial planning arena for about 10 years. And Heather is the aged care and Centrelink specialist, which I'm actually really excited to hear about how that works. And also on strategy around super and investments. So welcome to the call today, guys. We're really excited to hear from you.
Hi.
Nice
Hello,
to be with
everybody.
So basically, as I said, you can ask questions as we go, or however you want to run it. So what we'll touch on some basic things, and we can drill down into further detail if you wish. But just to explain, I own the business. I'm licensed with a Australian Financial Services license, as I have to be, which is a family-owned company. So we're one of the 30% or so financial advisors that don't have any institutional links. So about 70% of our industry has institutional ownership or institutional links. Not to say that they're the bad guys and we're the good guys, but generally they're incentivized to take you down a particular track, and we would say that we're not.
Yeah, I was wondering what that actually meant, so I'm glad that you explained it.
Yeah, so there's a few words that we're not allowed to use in the industry, but we're not institutionally owned.
Awesome.
There you go. And post-Royal Commission, that's probably something that might be in people's minds.
Yeah.
But yeah, we'll get started. So, I mean, the first thing is saving money. Lots of people are reading Barefoot Investor at the moment, which is great. So basically, I can talk about this young lady. She's not a client of mine, so I think I'm assuming she has reasonable income, Janine from Boost Juice. Saving money is probably the first thing. We would say, earn more, spend less, or do both. That's really effectively the only lever that we have for anybody. And I think a bucket approach to money, basically, looking at the now, looking at the medium term, and looking at the long term, is a great way to approach that. And that Barefoot, I mean, I'm not plugging Barefoot Investor, but Barefoot basically takes you through that process and has quite a good cash flow system. But if you can think of a bucket approach to saving, and most people get to the end of the month and they'll say, okay, we'll save what we've got left, and nobody has anything left. I've got clients on $50,000 a year, and I've got clients on $380,000 a year income, and they've got the same amount of money in the bank, which I just find extraordinary.
Yeah.
So
it's a whole money blueprint, isn't it? Like you get to a certain, and then your spending starts to make.
Yeah. Everybody lives to their income, myself included. It's really hard not to do that. But if you can draw a line in the sand and say, okay, for every extra dollar I have, some of it goes to fun, some of it goes to long term, some of it goes to medium term, and obviously now is important. But the more you can do that, the more you'll get ahead. And if you can keep clawing away at that sort of process, then that's the best advice I can give.
On our last financial call, we had someone talking about budgeting and different ways to set up your bank account. So I suppose in the terms that they use, this would be sort of like your spending account, then your lifestyle account, which is say for holidays, so which would be like your medium term, and then your wealth creation account, which would be the long term.
Absolutely, yeah, for sure. That's the best way. And I mean, that, as I said, that long-term bucket, that might be super. For most people, that's super. For other people, that might be an investment property or a business. So there's different ways to look at that. But if you can sort of start getting your head around that bucket approach and that budgeting, that's brilliant. There's a whole raft of budget programs these days that suck information out of your bank account, and you can code it if you want to get really specific. But that's probably a whole nother. Now, when we talk about investments, it doesn't matter today about whether it's you personally, whether it's a company structure, a family trust, basically or a super fund. All these investments are effectively the same. The different structures have different tax aspects and different implications, but and we'll touch on particularly yourself and super, but the different structures don't really matter. The underlying investments are, effectively the same. So I must say one of the things about, if people are new to investing, I think my industry probably promotes itself on that we know more than everybody else, and if you give us enough money, we'll let you in on the secret. I can tell you, there's probably no secrets, and that's absolute, BS. I think, and the financial industry has run like that throughout history, but I think hopefully that's slowly becoming unravelled. But it's about plugging away at a few sort of simple strategies. So, Heather.
Investments, types of investments that you might like to think about. You might like to invest in the share market, and you can do that either by directly buying shares or investing in shares through a managed fund or super. Maybe you might like to buy some gold, a hunk of gold. Some people like to see something for their money. Another thing, another way you can invest, of course, is just in the cash economy. So putting it in an online saver to make a little bit more interest, or a term deposit, or buy bonds or something like that. And then, of course, there's property if you've got a little bit more money. And when you buy property, you've got the potential for rental income as well as capital gain when you want to sell it down the track, or so the property will hopefully gain in value over time. Oh, and then tucked up over there in the corner, and I forgot about that one, the Bitcoin.
Do we want to talk about that?
No, not really. Some people, there's a lot of people talking about Bitcoin at the moment, and some people are thinking they could make a fortune with Bitcoin. Now, we don't know enough about that, and we're not prepared at this stage to go into Bitcoin and to recommend it. But for those who have a little bit more knowledge about it, maybe they're the people to talk to.
Have you heard, Heather, there's a new cryptocurrency coming out?
Yes, there's quite a few of them. There's one that they think will rival Bitcoin too. So I guess, down the track, that might be something that people can think of. And I've even been to places where you can pay by credit card or debit card or Bitcoin.
Yeah. It's happening more and more, isn't it? It's becoming.
Yeah. I think crypto's a whole nother webinar. But I think what Heather's about to talk about with risk and reward, that's crypto is a classic, risk reward strategy. So it's only about risk and reward. There's nothing else. So.
So when you're thinking about where you might invest your money, you do need to think about risk and reward. So if there's low risk, there's usually very low reward. If there's high risk, it has the potential for high reward. So if you look at that graph there, right down on the left-hand corner, you've got the money market, so term deposits and online savers and fixed interest, that sort of thing. You mightn't get very much money, but you're not going to lose your money either, probably. So there's very low risk. About halfway up, we've got real estate. There's still risk with real estate. Some people think there isn't, but there's a chance that it won't be worth more than you paid for it when you're ready to sell. And over time, it's got a reasonable return. And then you get up to the stock market, where you've got good value stocks which aren't as risky, and they don't make quite as much over time. And then you've got all the risky ones further up. Now, these aren't short-term investments. You wouldn't invest in a very risky share market if you just want to save for next year's holiday, because they're investments that you would hopefully have in for at least 10 years, so that over time you're probably going to make a lot more money. But in any particular year it might not be very good. So here we are. If over the past 20 years up to September 2017, the cash and conservative investments have made an average of 5.1%. Best year was 8%, worst year 2.5%. So you can see it never went to negative. High growth, so some of those risky shares, average over 20 years, 8.2% growth. Best year 33.5, worst year 31.2. So if you can't take the minus 31.2, you probably shouldn't be investing up there because you won't sleep. So always it's, the higher the reward, the higher the risk.
So this is, don't forget, this is even within, super funds or any investment. The risk reward paradigm is always there. That's what, what you're looking at. So that's crucially important.
Yeah. So one of the types of investments, managed funds. Now this is something that pretty much anybody can invest in. When you invest in a managed fund, what you're doing is throwing your money in with thousands of other people so that your money gets spread over a lot more investments that you might be able to invest in just on your own. That doesn't mean, now you put it in the managed fund and then the fund managers will manage it for you. And for this you pay a fee. So it's not entirely free, but then you've got the potential to spread your risk over a lot wider scope of investments. You can still invest in investments that are sort of that suit your risk profile. So you might want to leave it in there for a fair while and invest in about 70% shares. So you can do that within a managed fund. You can invest in Australian shares or international shares. Now the Australian share market is only about 2% of the global share market. So by investing in international shares, that gives you a whole other scope of investments, which you can do within the managed fund. You can also invest in term deposits of cash and bonds and listed property within the managed fund too. So you choose what you invest in and the fund managers manage it for you.
So this is what people do with their super a lot, isn't it? Managed fund?
The structure will just look like super. Yes, you can do the same thing in super.
It's not in a super fund.
No, this is not in a super fund. So if you've got a spare 10,000, you can put it in a managed fund. You can decide how it gets invested in the managed fund. It's pretty accessible. If you decide, okay, I need 5,000 for a holiday, it's only going to take you a few days to get it back out again.
I was actually looking at this for the kids' savings. So we've been saving for the kids for years, and between them, they've probably got about $12,000, like between the two kids. And Imogen has quite a severe disability, and when she gets to 18, we don't know what that's going to look like. So I've been thinking it might be better off putting it in there for, 11 or 12 years, and hopefully by that time, it's built up to a point it had some sort of returns coming back in where she'd have a little bit more financial stability. Is that something that
where have you got that money now?
It's in a savings account that's getting like interest, like a good interest account.
Sorry, Sandy. So that's the classic risk reward conundrum, isn't it? So, as Heather explained, at the moment you might be earning 1% or 2% if you're lucky, or 0.5% in cash. That's absolutely safe though. So when we want to try to achieve a higher return, we've got to accept higher risk. And when we talk about risk in financial planning, risk is about potentially losing capital. Now, whether that potential is lost forever or that loss is forever, we don't know. But hopefully, if your attitude is it'll come back up, we know that, all I know as a planner, the greater the risk you take, the greater the reward will be. So if we go into managed funds or high growth managed funds, you'll get a higher return. But in any one year, as Heather said, you might get a minus 33%, and that could happen tomorrow. Yeah. That's the conundrum that we have.
That's if you're really in high growth, you might be a little bit safer within the managed fund.
Yeah. Or spread it across some lower risk.
And
that's right. Yeah, for sure.
Now, as well as managed funds, of course, some people like to just play around with the share market and invest in shares directly. And when you buy a share, you're actually buying a part of a company. So some people like to do the research and have a look and buy some shares. I wouldn't advise you to buy shares because you've gone to a barbecue and, Uncle Joe's just said, oh, you should buy some of these shares, because that may not be the right thing to do. Diversification is the answer. Is if you diversify the shares that you buy, don't buy them all in the same sector. So don't buy all finance shares or all mining shares or all health-related shares. Diversify your portfolio so you've got some right across the board. And then the ASX 300, that means the Australian share market, the top 300 shares returned 9.4% over 20 years up to 2018. So the returns were pretty good. Mm-hmm. But you have to realise it's a long-term strategy. It's not a short-term strategy.
Yeah.
Another thing that we will talk about with clients is property investment. So most people know how this works, but whether that be residential property or commercial property, most people will sort of gravitate towards residential, but commercial can be interesting as well. So property gives you a rental return, obviously, and also a growth or a capital gain, proportion of the investment. I've just done an example here, a $500,000 property, just purely for the numbers. If somebody was on a joint income of $120,000, would cost about $30 a week after tax. So when you do those sort of numbers, that's really quite interesting. People are sort of shocked at that sort of level of cost. So I've got a little graph here. If this circle sort of represents the total cost for you, you're paying basically 5% of that total property. The tenant's paying 74%, and Mr. Morrison, or the tax office, is paying you about 22% of that property.
Nice of you.
This came up obviously in the last election. The whole Labor Liberal. They were talking about property quite a bit. So this is what they're talking about. Those claims with property. But for that. Often depending on the income of people, we would do a property analysis to see whether it's that worth taking that risk. For some people, that $30 a week, it's worth taking that risk. Now, we have no idea whether this is going to go up, down, or sideways, but depends on whether that risk is worth taking for clients. For some people, it is. Superannuation. So basically, super could be any of these investments that we're talking about, but we'll talk about super specifically. So super has advantages and disadvantages. One of the disadvantages is that you can't get to it until you're 65 or 60 and retired, or there's a few other horrible situations where you can get to it, but generally 60 or 65 and retired. The advantages of super is that you can't get to it till you're 65, so it's growing for you as well. Some people love super, some people hate super. One of the main reasons that planners talk about super is the tax effectiveness of it. So it's a highly tax effective or reduced taxation structure. And the holy grail is that you can have $1.6 million, we wish, in super at a certain age, fully tax-free. So 100%, we're talking Cayman Islands, tax-free, completely legal. All the income is tax-free, all the growth is tax-free, and the money taken out is tax-free. That's sort of why planners talk about super all the time. It's that holy grail of that 1.6 million. Or you don't have to have 1.6, but up to 1.6 can be tax-free. So the reason people hate super sometimes is that massive changes in rules. That keeps us in a job, but it's horrible for most of the population. They play around with it all the time. There's a few strategies that we'll talk about: government co-contribution and salary sacrifice and a spousal contribution. We'll go through those in a bit more detail. Did you have any questions around the super side? People get.
So yeah, it's pretty clear.
Yep, keep going. So the government co-contribution, Heather will touch on that.
So that's free money from the government. Now, there is a condition. If you earn under $37,697 per year, and you make a contribution of $1,000 into your super, the government will throw in $500. So that's a free $500. Disadvantage, obviously, you can't get it until you can access your super at 60 or 65, and that will gradually go down until once your income gets up to 52,697, then they don't put in anything. So it just gradually decreases from 500. Now, if you don't have $1,000 to put in, but you have 500, they'll throw in 250.
Oh, cool.
If you've got 100, they'll just throw in, just a proportion of that. So you don't have to put in the whole 1,000, but they'll throw in a little bit. As long as your income's under the 52,697.
Yeah.
So that's worth thinking about for long-term strategy. But it depends on, of course, whether you can afford the $1,000 or not. There's also the option to do a spousal contribution. So if one partner earns less than $37,000, you can put in $3,000 into that person's super with a certain super code, and that the other partner will get a $540 a year tax offset. So that can be useful for some people.
So would the spouse who's earning under the $37,000, they would get the $500?
No. The person who has the larger income would get the $540 tax offset. So they'd pay $540 less tax.
Sure. Yeah.
It's just something, it's a bit of a sweetener. If you have that spare money, the $1,000 co-contribution and the $3,000, that's going to super. So some people don't want that locked away. And, the closer you are to retirement, the more incentive that is to maybe stick money in. The younger you are, maybe you want to use that money.
You don't want to lose that money for too long.
For something else.
Yeah.
Another thing that people talk about is salary sacrifice. So basically salary sacrifice, don't forget there's a different thing called salary packaging. Often if people are working for non-government organisations, not-for-profit organisations, there's salary packaging, which is quite valuable for people. So, but salary sacrifice as well is adding pre-tax money to super. So once again, adding pre-tax money, the money is taken away from you and put into your super fund. Eventually you get it, but you're missing out on money now. So, that depends on whether you can afford to miss out on that money. So just as an example, if I had somebody on, say, $70,000 a year income, and I took $5,000 away take-home income, as in that's, walking in the door money. If we took $5,000 away from them, so they missed out on $5,000 a year, basically they would save about $1,700 in tax, in net tax, and they're boosting their super significantly and therefore their retirement income. As I said, the downside is that $5,000 you don't get to, or there's going to be significantly more money, but you can't.
But that tax saving ends up in their super.
That's right. So the tax saving and the pre-tax money ends up in your super account. So that can be great. When I said back in the beginning, everybody lives to their income. This is a classic. If you can do this a little bit to start off with, maybe as your income increases, you might do this on a minimal level and then gradually increase that each year. Or let's say there's school fees that you used to have or something, and now you don't. This is a classic where you could start plugging away at maybe retirement.
Can you salary sacrifice into a self-managed fund?
Yeah, absolutely. So whether it's self-managed, I can't give advice today, but whether it's self-managed or stock standard super, industry fund or retail fund, it doesn't matter. The structure of that doesn't matter. It's regulated by the super rules. So yeah, for sure.
And if I might have a separate conversation with you. I've got all these questions. I'm like, oh, I wonder.
No, far away. We'll touch on self-manage a bit because everybody's talking about self-manage. So yeah, but far away, yeah. So that doesn't make any difference. As I said, the downside is you can't get the money back, until you meet a condition of release, which is accessing your super at some point in the future. So you just have to be aware that you're giving up money, but it's forcing you to save for the long term. Here we go. We'll talk about self-managed. So self-managed super funds, everybody's talking about that. Dave at the water cooler or whoever is talking about, I've put my money in self-managed. It's the best thing you can do. Everybody should be doing it. I'm a self-managed super accredited specialist, but self-managed, I probably talk as many people out of self-managed as into self-managed. So in itself, really, there's nothing different with self-managed super funds than there is with stock standard, your stock standard Aussie Super or your Hester or your Colonial or your AMP. But the only difference is property. So with self-managed super, you can own direct property. With these other stock standard supers, you can't. And for me, that's the only reason. I'm not suggesting people do this, but the only reason that I would mention self-managed super for clients is if they wanted to invest in property, if they were super keen on property. Yep. I don't really see a lot of advantages, and there might be some arguments in our industry about this, but if you pull out, your $100,000 out of Hester and stick it in a self-managed super fund and invest in managed funds and shares and the normal stuff that everybody is doing in a Hester fund, I don't really see much advantage, and there's probably more costs involved in self-managed. The setup of self-managed, the running of self-managed, the implications of self-managed. You're as a trustee of a self-managed super fund, you're responsible for every dollar in that fund for everybody in that fund. So you've got to be, you've got to be switched on, and generally you're paying for advice on that, paying your accountant more money because the audit has to be done and admin has to be done on the self-managed. Very distinct. Well, there can be significant advantages if you own a business or are renting premises for a business. So you own business premises or renting business premises. That can be an advantage, and people might like to start a self-managed fund for that reason. When I say you own property, the first thing that most people say is, can my super fund buy my house? And the answer is no. They can invest in residential property, but they can't buy your house. You can't give the money to yourself. So there's quite a number of rules and regulations around super. Super can borrow money, which is interesting, to buy property. So that's a webinar in itself.
It can buy your business property, though, can't it? That you're going to rent from your super.
That's right. So yeah, that's where it's an advantage. Can be an advantage if you own a commercial property or a business property, or renting a business property. Did you have some questions on that, Sandy? Or?
They're probably more around our situation in that we run multiple businesses.
Yep.
And we have a self-managed super fund because we did invest in property.
Yep.
I would say that our investment in our own super, since we started our own business, has been quite minimal.
That's typical.
That's typical of every self-employed person, myself included, probably. Yeah.
I'm just thinking, can a self-employed business person salary sacrifice and still do that?
Yes. So the answer is you as anybody can contribute to super. Mm-hmm. So whether you're self-employed or so, salary sacrifice is classically my employer. I write to my employer, and my employer takes X amount of dollars per week away from me and sticks it in my super fund. But as a self-employed person, such as myself, I can actually just throw money in. There's limits, but I can throw money into my self-managed super fund or my bank account, my super fund.
Yeah.
So I can throw money in, and that's a contribution, and I can claim that contribution as a tax deduction, which is exactly the same as salary sacrifice.
Yeah. Okay. Great. Cool.
Yeah. So whether you're self-employed or not doesn't make any difference. Actually, one of the interesting things we didn't talk about with salary sacrifice is you used to be back in the day. You had to put money in through the income system, so through your wages. Now you can actually throw money. Anybody can throw money in at any time. So you can get to the 1st of June each year, look at whether there's an event, hopefully you see a financial advisor such as myself, and say, is there an advantage to throw money into super or not based on my taxable income? And, you might have a pool of cash outside. So you say, okay, you can do the figures and throw 16,222 is the ideal figure to throw in. So, whereas you don't have to put it through your income these days. Yeah.
Okay, cool.
Reducing debt.
Okay. One of the ways to maybe not save money, but to have more money at the end is to reduce your debt. So if you've got a $300,000 loan at 5%, and hopefully you're not paying 5%, the total you would repay for your home loan was $580,000. Now, by paying an extra $400 per month, you save 11 years and $110,000 in interest, which is a huge saving. Now, some people mightn't be able to throw in an extra $400 per month, but even if you can put in $20 a week or $50 a week or something like that, it's going to make a big difference to the total of the amount of interest you pay in the long term.
Yeah.
So reducing your debt is beneficial, as well as not reducing the debt and throwing money into investments of some type.
Mm-hmm.
It's horrendous, isn't it, that figure, Sandy? I saw you react to that.
Oh, because Steph's about to buy a house and
yeah.
Just looking at this.
I mean, most people would have significantly more than $300,000 debt too. So when you look at the numbers that you're actually repaying, it's
well,
horrendous.
the thing is, at the beginning, you're usually struggling just to make the monthly repayment, the basic monthly repayment. But after 5 or 10 years, and your income might have gone up, you might be able to throw in an extra bit of money, and that's where it all helps.
Yeah. So it's plugging away at all these strategies. We would say, don't just go into paying debt necessarily, but maybe it's a bit of all of these things.
Exactly, yeah.
So credit card, we'll have to mention credit cards because we often see clients, they might have $20,000 in debt in a credit card and then have $20,000 in the bank. And they say, we sort of nicely say, oh, what are you thinking about with that? They might be earning 0.5% on their $20,000 in the bank and paying 12% on their credit card. And we sort of gently point out, they say, oh yeah, but I want the cash. And we say, we gently sort of say, well, you actually don't have any cash, so you owe the bank that amount of money. I mean, that's very much human nature to have that situation. People don't want to give up their money, but
it's their safety blanket. I feel like, because they feel safe if they've got money in the bank, but it's costing them more.
Yeah, but I mean, I can completely see that, but you're just pouring money down the toilet, aren't you? Because paying 12%, you're not going to get 12% even probably high growth super, or you might get 12%, but you're not going to get 16% in a high growth super fund probably. So, we would say concentrate on the highest debt, the highest interest rate first. If you have multiple loans, even if it's only $1,000 at 12%, you pay that $1,000 off first. You get rid of the highest interest rate first and gradually move down. Often people will gravitate to the highest amount of money. That's sort of, I know that's seems counterintuitive, but people like to pay off the $300,000 debt before the $1,000 debt. But whatever debt is costing you the most, which is the highest interest rate, pay that off first. That's the general rule.
That is a great tip.
And that's generally a credit card.
Generally the credit card, yeah. Tax deductible debt and non-tax deductible debt, home loan, credit card debt and home loan debt is the first debt you would get rid of. Then we might talk about maybe investment property debt or other debt. So there's sort of good debt.
Good debt.
Sorry. Yeah, there's sort of good debt and bad debt. Yeah. Eventually you want to be out of all debt, but there's.
I think even too being like smart around. So for example, we just got our son a new bedroom suite, and Harvey Norman had 50 months interest free, right? And then when you get the finance, like if you're not really careful about the it's not interest free because you've got to pay a monthly fee, right? You've got to have an establishment fee. And then if you go over that 50 months, and often people don't read these fine prints, it's 29% interest.
Yeah, it's horrendous.
You've just got to be so careful about what you get yourself into, and make sure if you do those things that it's to get it paid off as soon as you can, not drag out the whole 50 months.
Often, or sometimes, I shouldn't say often, but sometimes those repayments that they give you are not enough to meet that time frame as well. So you've got to be really careful to actually go, oh, hang on, we need to pay this extra to meet that 2-year time frame or whatever to get the interest free. So you've got to be really careful. We see so many people, not just younger people, but people of all ages in, credit card debt or store card debt, or it's just terrible, and once you get to a level, you just can't meet those repayments, and it's significant. So that's living, spend more, earn more, spend less, or do both. That's it.
You don't want to get to retirement age and find your super is just going to pay off all your credit cards.
Yeah. So it's living, in a way, it's living within your means again, isn't it? It comes back to that. It's sort of, that boring strategy that we keep harping on about. So
totally.
One of the things we didn't want to talk about the horrible stuff, but we need to. So we, as a planner, I would say, have appropriate insurance. When I say appropriate, we're not trying to flog off insurance to people. I personally dislike my insurance, but I know that it's there for a safety aspect. So appropriate insurance is about, if you keeled over yesterday, is your partner or is your family covered to the level that you want? Now, maybe they don't need any cover. Maybe their job's not impacted. Financially, they're not impacted. So you don't need cover. Often we'll see clients with lots of cover or too much cover, or clients with not enough cover. People don't seem to think about this side. There's all different strategies around insurance. You can get insurance in super, and there's a whole other topic, rabbit hole to go down there. But life cover, so death, TPD is total and permanent disability. There's cover for traumatic medical events, traumatic medical events, strokes and heart disease and whatnot. And there's also income protection insurance. So most people don't think about it.
Particularly important for our group, though, because of our child's additional needs. So
absolutely,
that whole concept of, if we're not here, then who looks after our children and what supports do they require? Because they often need 24-hour care.
Yeah.
So often we'll see the carer and the income earner, and they'll say, "Oh, I've got enough insurance. They'll be fine." And you say, "Well, really? Let's go through the scenario. You're at work 9 to 5, or probably more like 7 to 7 these days. Are your children taken care of? If the carer is not there to look after the children, you're going to have to pay for care or bring care in, or maybe it's parents or maybe it's other people, but can you earn the same income as you could last week?" And the answer is probably, for most people, no. So you need to think about that.
It's not just the mortgage that needs to be paid.
Yeah. So people really need to step through that process and just make sure that it's enough. And maybe it's not forever. So maybe at certain stages of life, if I had a 2-year-old, I'm going to have a lot more insurance than I have if I have a 20-year-old. So, or a 25-year-old. So, it's not forever, but you just got to be aware of this. Yeah. So keep going on the bad stuff, but estate planning is important when we talk about investments and general financial planning. For most families, maybe a normal will is appropriate for estate planning. If there's not children from previous relationships, maybe a normal will is fine. Testamentary trusts are more complicated, but can take out some of that aspect if there's children from previous relationships, or for particular reasons. Maybe we set up a testamentary trust. So that's a trust that the capital is not accessed on your death, but the income can be accessed. So that can be quite a powerful tool in estate planning. And there's a whole range of disability trusts, they can be an estate planning mechanism, or while people, while parents are still alive, to put money into trust. But there's advantages and disadvantages with those. So you need to really get some good planning. There's some Centrelink implications and tax implications. So you need to talk about all that sort of stuff. But estate planning would be something that's important, I would highlight. So for people to think about as well. Most people, sort of stick their head in the sand and don't think about these things, but, Friday night over a glass of wine, it's probably good to talk about some bad stuff and, just say, well, what would happen? What insurance is appropriate? What are we going to do about the estate planning side? Yeah. So some tax strategies, we've already touched on some of this. Salary sacrifice is a classic. If people have a capital gains tax event, so they might have sold a property, there's a whole raft of strategies around saving some of that tax, which can be interesting. Superstructure is probably not appropriate for your group's age level, but at a certain stage in life, as we said, people can have access to this fully tax-free super account. So we don't see people take advantage of that. So over a certain stage of life, they can access that. Even younger people who have been TPD'd or permanent incapacity can take advantage of this tax this tax structure as well. So basically, you get a tax-free super account. Whether to invest in super or out of super is it? I have that question myself. Do I put an extra $1 into super? Do I put an extra $1 into mortgage? Do I put an extra $1 into investment? And I would say, yes, you do all of those things. We don't know which is the best. So plug away at all those things if you can.
Yeah.
So as I said, there's no secrets. It's about the sort of mundane, boring strategies of just plugging away, living to your income.
Your business sounds so exciting when you keep talking about mundane strategies.
Sorry, I'm trying to be realistic, and it's not. There's a
line, isn't it?
I'm glad you love the boring stuff, so then we can do the boring
We can just learn the strategy and take it.
Well, it's about plugging away. There's a great book called The Millionaire Next Door, and it's about the stock standard people that you don't expect. It's the working and plugging away. I mean, we love to hear stories about the multi-millionaires that have sold a company or something, but in reality, that's one or two people. That's why we hear about that. But it's about plugging away at those strategies, living to your means, all that sort of stuff.
Totally. Well, we always talk about consistency and consistent daily actions with any area of health, and finances is just the same.
Yeah, absolutely. Yeah. So there's a bit of an age where there's an age difference between couples. There's some super strategies there, but generally that's when we're getting older into Centrelink sort of strategies. So probably not worth talking about that. But we have an offer at the moment for you guys. We generally charge for a full analysis. We'll charge generally $550 for a couple to look into everything, but decided to cut that to half. That's a full analysis of super funds, insurance, and what we think we can help you with going forward. So you can put that up to people.
Fantastic.
But fire away with any questions, comments.
No, I think for me, like my husband and I have just been given some money from the UK. So we're currently in a position where we're looking at what we can do with that. And, it was sitting in our bank account for a couple of days and we're like, ooh, it's scaring us. Like, what do we do with it? Do we put it away? Do we invest it? So it's really interesting to just hear you talk about different strategies and ideas, that things I didn't even think about. So, and getting that analysis is a really awesome option because people have, all their cards laid on the table and a plan. So that's
because it's one size fits all.
It is,
and it's it's important.
Absolutely.
Yeah.
Well, that analysis would include getting all the information from you via a form you'd fill out and send via email, and then a meeting to talk once we've analysed it to see what we could do for you.
So our business has a two-step process with clients. So we basically have a information session, and that can be done online as well. But information session, then we analyse that. We talk to the super funds. We'll analyse the insurance. Then we'll come back to you and say, well, we think we can help you with this. We'll have a face-to-face meeting in the second meeting, and that covers that price covers both of those. And then we basically say, we think we can help with this. This is how much it would cost if there's a cost going forward, and that's how we work. We like to sort of know the answers before we have that second meeting for the client. So,
people have like a little nest egg, but like that with insurance, they don't know what they do, or they might not even have insurance or whatever, would you then guide them on like what they could do as an
Yeah, for sure, yeah. And when you were commenting about the money, you know, in the bank account, sometimes there's not a perfect right answer either. Sometimes, you know, even I say to clients, sometimes there's no direct answer. We can do this, or we can do that, or we can do this. So
that advice, or a fresh eye, or someone who has an idea of those strategies to at least, you know, and then we can make a decision based on that.
Well, it depends on your goals too. So your goals might be different to my goals. So
absolutely, yeah, for sure. One of the things, you know, something Sandy touched on earlier was saving for the children. You know, we have clients that talk about that side of things, and you know, we'll look at the advantages and disadvantages of that. You know, whether it's better to build your wealth, or whether it's better to, you know, plug money into, you know, it completely depends on what you want and circumstances as well. So everybody's slightly different. Yeah.
With communicating with people, because we've got members all over Australia, so if they're not local, you can do like video sessions.
Yeah, for sure. So we do video. Generally, the first we'll get an information sheet sent out to them. They fill that out. They give us a letter of authority to contact the super funds or insurance companies. We'll drill down into all that information and then come back to them on the video to say this is what we can do. We have clients all over Australia, so obviously, you know, majority are in the mountains, but we have clients all over the place. So.
Beautiful.
Yep.
Awesome.
So, some are happy to do it by email, and some like to do a face-to-face video.
Yeah. I suppose when you're dealing with people's money, you know, often they want to, you know, it's nice to
see what you look like.
They trust, you know, there's a high level of trust in what we do. So, and you know, with all the stories of the financial world over the last few years, decades, you know, you have to be happy with what they're doing. So
absolutely. Well, we really appreciate your time today and for, you know, giving us so many tips and options. And I know there'll be lots of interested people after watching this.
Yeah.
I'm already
education, isn't it?
So,
I'm thinking the same.
I mean, if people have just general questions, and you know, I'm happy to answer emails. You know, if they flick and say, "What do you think about this?" I can't give advice at this stage, but you know, I'll say in general. You know, this is what you would think about. So I'm happy to do it.
All right. Well, we'll have your contact details. But Adam and Heather, thank you so much for joining us.
Thank you, Sandy.
Pleasure.
Thank you.
Thank you very much.
Bye.
See ya.